there is a book that I read recently where they said the number one factor in improving shortening the timeline between where you are and financial freedom is your savings rate. It's not rate of return. It's increasing your income, decreasing your expenses, and saving more of that money in a safe, secure way so that you've got a big piece of capital that you can put into, low risk investments and still produce a large enough volume of return that it makes a meaningful difference in your life.
Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kesler, and we ask ourselves, do our dollars make sense? We are almost to my favorite holiday. Well, one of my favorite holidays. Halloween, I think, is probably my favorite holiday. But 4th of July, hello, right around the corner. Super excited. You will catch Sadie and myself at Lake of the Ozarks. All right, y'all know Lake of the Ozarks. It's right in between Kansas City and St. Louis. Because for y'all who don't maybe know where I grew up at, Kansas City, I'm a Kansas girl, Midwestern girl. But I will never change my Floridian residency, let me tell you. Love living down here in Florida. But when I was growing up, mom and dad raised us in a town called Olathe, Kansas. It's about 30 minutes south of Kansas City. And mom's parents had a place on the lake in Lake of the Ozarks. So mom and dad would always go down there for the weekends, when they would close the chiropractic office for the weekend, drive over to the Ozarks. And so it's just kind of like a tradition. It's our home spot, so that's where we like to go spend the 4th. Be safe, my friends, okay, as you're hanging out this coming holiday. But I'm excited. We have a fun topic here. And this is actually a topic I've been getting deeper into, especially with my live stream show. If y'all don't know, Money Mornings with Hannah, 9 a.m. Eastern time every Thursday. You can come and join me live. Just click the little bell icon here on YouTube and you'll get notified when I go live. But I just did a segment where I compared the two philosophies of buy term and invest the difference versus the infinite banking concept and leveraging the cash value from the policy to go and make those investments, and really doing like an apples to apples comparison and really digging into the math behind it all. So go check out that episode. But as I was going down this rabbit hole of the returns, if you will, and really looking at the S&P and mutual funds and bonds even too, a lot of the wealthy people, they're not always going out there and chasing the returns. Yes, cash flow and revenue is important, but they're looking at how are they protecting their vault, the dollars and the capital that they already have. And a lot of the times when we get into our wealth building and investment journey, we're always wanting to go and chase these returns, which is great, right? As we say it over here in the Kesler family, go take your little green men and go put your little green men to work, your dollars, right? And that is important, but also you need to protect what you have, because queuing up Brent Kesler, he always says that pigs get fat and hogs get slaughtered. I want to be a pig and I want to get fat. I don't want to go out there and get slaughtered, right? So I really want to introduce this conversation of how can we continue to build wealth and minimize risk, look at the longevity without always just focusing on chasing those returns. So I'm super excited. I also have a guest here today, Mr. Wesley. I call him Wes. Larry and myself kind of gave him a nickname. We call him our 17-pound brain. I don't think I've even told him that yet. But Wes is a part of the Money Multiplier team. He is on the implementation team, the mapping team. So if you are a client of the Money Multiplier, you have your designated implementation agents that you can go and use as you need, right? If you want to figure out where are my MEC limits at, maybe my spouse pissed me off and I need to update the owner and the beneficiaries of my policy. Wes, how do I do that? But more importantly, they're really there to help you strategize, because you got to plan for investments that come up, your expenses, big bills, taxes that we got to pay, right? And so you got to always prep for some of these large expenses too. So they are a team that's there to support you, and it's a free resource that we do for all of our clients who are a part of the Money Multiplier. So I want Wes to introduce himself as well. So let me bring him onto the show. Good morning, Wes.
Hey, Hannah. Good morning.
I am excited. We have never podcast together. I don't think my people know you yet.
I'm definitely excited. I appreciate you having me on.
So, Wes, real quick, do a quick little intro of you, where you live, what you're up to in your day to day, and even just like a little glimpse of your background of how you got introduced to infinite banking.
Yeah, sure. So I live in Syracuse, New York area. I've been with the Money Multiplier now on the implementation team since it's almost 3 years now. It's crazy how fast that time has gone by. Have a lot of background in banking and economics and finance. So when I had originally gotten my first policy through the Money Multiplier, Larry was my implementation agent, and I told him, I think it was in our very first call, I told him, I said, hey, look, I love this stuff. I nerd out on it all the time. I've spent hours researching it. If y'all need anyone to be on your team, I'm your guy.
Call me.
So I think it was like, maybe he was like, yeah, send me a resume. So I think it was like maybe 3 months later, he called me and set up an interview with myself, him, and your mom. And I remember I was rushing around that day, and I went into a public library to set up my laptop to be able to do the interview with your mom. So
Yes.
that's kind of how I got started in it all.
And you are up there in New York as well, New Yorker, Syracuse area.
Syracuse.
Yep. So I know you're north of me, so good. Hey, talk to me about this. Being on the team for a little bit, what are some of the biggest success stories? Like, I want to ask you, when do you see people having that light bulb moment go off and the dot totally connects of, okay, this stuff is real, this stuff is true? Because I can tell you from being out there educating, speaking on stages, people will get it, but it doesn't totally click until they start their first policy. They're actively using the cash values, paying themselves back. When do you see that big light bulb moment for a lot of people?
I think the biggest point is when they, especially with individuals who come into it having debt to pay off, when they start using that policy to pay off the debt and recapture those monthly payments and have control over it, that's a huge light bulb moment for a lot of them. Because I remember being in the situation myself where I was at a point where I had debt and I had some money saved, and I wanted the debt to be gone, but I didn't want to give up the money that I had spent all that time saving.
Straight up.
And so I was looking for that way to have my cake and eat it too. And I think that there's a lot of people out there that find themselves in that same situation where it's like, what should I do? And oftentimes that's what leads them to us.
Yeah.
But then once they actually start doing it, and it's not just concept, it's actual, the rubber actually meets the road and they start doing it themselves. Just that first step of implementation is where I really see things start to click. And taking that a step further, the individuals who continue to, whether it's reading books, listening to podcasts, watching YouTube, the people who did that up to the point of getting the policy and then continue to do that after they have the first policy, those individuals, their learning curve is just so steep and they get such good results from it because it's no longer just concept, it's actual practical and actionable steps that they're taking that are solidifying and crystallizing those concepts that they learned up to that point.
No, straight up. And that is my biggest PSA. And I think you said it so beautifully. You do need to continue on your education because things are always changing. You know what a client told me yesterday that I thought was super surprising because we got on the topic of taxes? She goes, did you know that they are changing the tax code 2 times a day for the last 15 years? They've been changing the tax code 2 times for every single day over the course of 15 years. It's a lot of changes. It's a lot of upkeep, and you got to be in the know. I always just think about the one-liner that Nelson Nash would always say, if you know what's going on, you'll know what to do. So you just got to be in the know. And I mean, honestly, that's the whole reason that I do this entire podcast show is just to continue to help you folks as you evolve in this journey. But also I wanted one thing that you mentioned, and I want it to be clear for the listeners as well, is what we're talking about, right? I think my listeners understand that, hey, these are whole life policies. But if this is your first time tuning into the show, when we're talking about the infinite banking concept, it's a whole life policy that we're using. Now, this whole life policy, however, has to be structured and designed to have immediate access to cash value. And that's what we do. That this is just 100% of what we teach and helping folks implement is this concept. And a lot of people that are showing up at our front door, I mean, they're in debt. I mean, 80% of Americans are living paycheck to paycheck. And I saw a study just yesterday as I was scrolling through Facebook. Somebody posted out there that 60% of Americans cannot survive a $600 expense. That will totally wipe them out. And it's like, oh crap, y'all, we are severely undercapitalized. We need to continue to build our capital and have a place to store it. But anyways, you know, what Wes is saying is that instead of me just taking my money from my checking account or my savings account and paying off these debts directly, and now the money is gone forever, what I'm going to do is I'll flow it through my policy first. I'm going to leverage my policy, pull out the cash value, which is not my money. It's the insurance company's money that I'm using. I still have my money in that policy growing interest and dividends. And so I'm using the insurance company's money to go pay off these debts. And now the debt's paid off, but I never lost my money, right? Because it's always inside my policy earning me that guaranteed interest and dividends. And I think people get excited, right? They get really excited when they hear about that. But then there comes this point where they just kind of quit their learning. They almost hit that arrival syndrome. And I guess that's kind of the perfect segue into what I wanted to ask you next, which was, what are some of the biggest mistakes that you see from folks who have policies and implementing this, but maybe incorrectly, for lack of better words?
Yeah. The arrival syndrome is definitely one of the biggest mistakes that I see. And it's a recurring thing because there's so much excitement and anticipation leading up to getting that first policy in force. And it's not a short process. It doesn't happen overnight. So there's a big buildup for them leading up to that point. And then when they finally get it, it's like, finally, we're here, right? And so they're excited to get started, but that learning mode, I see it kind of click off for a lot of folks. And as a result of that, they're not staying plugged into the rules and the principles that Nelson laid out in becoming your own banker. and they'll naturally kind of drift back towards the way that they were brought up or the way that they had always done money.
Yeah.
Right? Infinite banking is something that you do. It's not a policy that you buy. The policy is just the vehicle that we use. Okay. Really, any asset that can be collateralized and borrowed against could be used for infinite banking, but these whole life policies lend themselves best to doing it. And so if they get off track with that, that's where I really see a big mistake for them. Over leveraging policy loans, right?
Dude, I've been griping on that in my morning show recently.
Yeah. Well, it's, I'll use the example with folks when I'm talking to them. I go, hey, if I gave you a credit card, would you go out and max it out right now?
Nah.
No way, right? It's such an obvious answer to them. It's like, well, why would you go out and max out your policy loan?
Straight up.
Right? Or why would you, if you had X number of dollars in savings in a savings account, would you go out and you just spend it all today? Probably not.
No.
Right? And so I think sometimes we have to demystify the whole life policy. It's like, just because you have a whole life policy designed for the infinite banking concept doesn't mean that the fundamental principles of personal finance are now negated.
That's straight up.
Right? The practicing IBC, I really think, is a magnifier for somebody's behavior and character and integrity around money.
Yeah.
Because if you don't have those fundamental traits and behaviors, it doesn't matter if it's IBC or this thing or that thing or whatever, right? Bad financial habits are going to bleed through no matter what. Right. So bringing some of those bad habits into it and not changing those habits, another big mistake, and just having that short-term thinking, right? That's another one of the principles, is think long-term that Nelson talked about. I had a client just yesterday ask me, and this was a client I hadn't talked to in a while. And he had a few questions. They were great questions. And the first one that he asked was, well, how long do I have to contribute to this PUA rider?
Yeah.
Okay. And it's a legitimate question, but from the position that I'm in working with clients, it's kind of a red flag question.
It is. It is.
It really reveals where somebody's mindset is on what they're doing. And it comes from just a lack of knowledge and understanding. And there's a big correlation between the clients that I talk to on a regular basis and the ones that I don't.
Yes.
Right? The ones that we don't talk to very often are the same ones that are asking those types of questions.
Yeah. And I hate to admit, y'all, sometimes I'll be calling up Larry and Wes and I'll be joking with them on some of the stuff that y'all are telling us, because it's about the mindset, because then you have to get into your education mode now with that person and say, well, technically you could stop paying your PUA premium whenever you want to, honestly, but let's look at this. Why do you want to keep paying this? I say, have you ever made too many deposits into your checking account or your savings account? Hopefully the answer is no. Why would you ever want to stop capitalizing your personal assets, your personal bank, right? And sometimes I think people can get hung up because they go to YouTube University and there's a lot of folks out there teaching on this. And when you kind of use street language and not so much the maybe the right word, mechanical language, if you will, hey, this is a whole life policy, an overfunded whole life policy. And how do you overfund it? By overfunding into the paid up additions, right? You kind of will lose people. So I get that. I get why people are using street language to educate the public. But at the end of the day, it's so simple. It's just a life insurance contract, y'all. And Wes, I want to ask you too, because that's a perfect place to start. You have to have the fundamentals around money. It's just like saying, should everybody have a credit card? Hell no, because some of y'all ain't disciplined with the credit card. But if you know how to use it properly, it can be a great asset to you. So I want to ask you, Wes, totally excluding infinite banking and whole life insurance out of this, what do you think are some of those fundamentals that people should just have at a personal finance level?
Long-term thinking, 100%.
Yeah.
Right? Because Rome wasn't built in a day, the old saying. But I can hear your voice in my head right now, quoting your dad. It ain't how much you make, it's how much you keep. Yeah. Right? So that's another big thing is make more money than you spend less money than you make, and create that gap. Okay. Yep. And for those that aren't aware of it, listening to it, that gap between what you make and what you spend is called cash flow. Okay. You can improve your cash flow 3 ways: by increasing your income, decreasing your expenses, or a combination of the two. And you need to know what that number is.
Yeah.
So being organized and tracking, right? It doesn't matter how you track it, right? I think a lot of times people kind of get caught up in the granular details of that sort of thing. If you like tracking your money in a checkbook ledger, do it that way. If you like doing it on pen and paper, fine. Spreadsheet, fancy app. I know you're a big fan of Rocket Money, right? I like the formerly known as Personal Capital. That was the one that I like to use. It doesn't matter what it is. The act of tracking it and being organized is what really matters. Mm-hmm. So long-term thinking, being organized and tracking, and just living below your means. Those are the big. I would say those are the big 3 takeaways for traits of successful people with money.
Straight up. And with this whole topic, how can we continue to build financial freedom without chasing yield? Okay, just real quick, let's talk about yield for a second. Chasing the yield, chasing the returns, okay? How often, we're talking about people who are totally over leveraged, okay? We've been seeing that kind of come up, especially with our real estate investors. But when you continue to chase these yields, you're continuing to move that money from like one investment to the other. It's almost like an every 6-month type of thing that you're doing. You're chasing those higher returns, jumping the investments as mentioned, and you're kind of like looking for those shortcuts. And that's even something else at the foundation of what Wes just said. You gotta think long range. Wealth is built. Nothing is truly a get rich quick kind of deal. And is there something like that out there? Probably, but it involves more risk. And as I said from the start of this whole episode, the wealthy folks are not going out there and chasing these instant gratification returns. They're truly setting themselves up from the foundation level that this is me protecting my vault, my family's financial future, and the legacy that I'm going to leave to them. And yeah, I know like those high returns are exciting. I've even got some exciting high returns, but at the end of the day, I don't put all of my eggs within that one basket.
100%.
Wes, what are you seeing our clients invest in mostly? Are most people paying off debt? Are they investing? What if they are? What kind of asset classes are they investing in?
The spectrum of that is wide and deep. There's a lot of different variety in that. For the vast majority of people, especially individuals that I'm having conversations with on a regular basis, I tell them, look, because they're asking about investment opportunities, right?
Yeah.
And I constantly have to remind them, look, I'm not an investment advisor, right?
Yeah.
I can't tell you what to invest your money in, but I would say the majority of the time, especially if there's debt in the picture, the best bang for their buck is paying off that debt.
Yes.
Not just from the percentage standpoint on the rates, but from a cash flow standpoint, right? Conversation with a client yesterday. He had a car loan that there was under 10K left on the balance, but the monthly payment was over $500 a month.
Mm-hmm.
Right. And I said to him, I go, hey, how much money would you have to invest into a real estate deal or something else to get $500 a month of cash flow?
Yeah.
And, it's a much bigger number than paying off $9,000 of debt.
Straight up.
Right. So that kind of goes back to what I was talking about earlier with increasing your cash flow. You increase your income, you decrease your expenses, or a combination of the two. Well, decreasing those debt expenses is the fastest, most controllable, and safest way to do that. Right.
Mm-hmm.
So I would say that's number one in terms of conversations with clients that I'm recommending. I do see a lot of real estate stuff. You and I have had conversations in the past where, it's not to pick on the real estate investors, but I see a lot of the big mistakes that we talked about earlier in this conversation. I see a lot of those big mistakes specifically from the real estate community.
I know.
Right? At the end of the day, well, actually, before I go into that, another story of a client that I spoke to within the past couple of months on the topic of yield chasing. They lost like $160,000
Yikes.
in it was some kind of, it was like a Ponzi scheme, but it was packaged as like a real estate deal. And the promise was 20% on the money, right? And they got caught up in the shiny object and the sexiness of the yields, right? Versus the fundamentals of, how to protect the downside.
Yes.
Now, the good thing for those folks was that the money that they borrowed to fund that was from policy loans and not from a bank.
Good.
Right. And so in the conversation, that client felt really down and out, but that was a silver lining for him because, there's no bank there's no bank knocking on the door asking for that money back.
Yeah.
Right. They can pay that policy loan back at their discretion on their own timeline.
Mm-hmm.
Right. So, that's an example of the dangers of yield chasing. Okay. At the end of the day, and I'm sure you would agree with that, I would rather earn moderate returns on huge sums of capital
Mm-hmm.
than trying to squeak out maximum returns on itty bitty pieces of money.
I always say, do you want 50% of the watermelon or 93% of the grape?
I like that one. But yeah, I mean, it's the perfect analogy. Like you can grow large sums of capital very safely and predictably
Mm-hmm.
by just having excellent savings habits and, not spending every single dollar you make. Right. There is a book that I read recently where they said the number one factor in improving shortening the timeline between where you are and financial freedom is your savings rate.
Yeah.
It's not rate of return. It's increasing your income, decreasing your expenses, and saving more of that money in a safe, secure way so that you've got a big piece of capital that you can put into, low risk investments and still produce a large enough volume of return that it makes a meaningful difference in your life.
Hey, sorry to interrupt the episode here, but I want to take a quick break. If what you're hearing today has made you curious about infinite banking, how it works, I want you to go watch my free presentation. In it, I walk you through the same steps that my family took to pay off $984,000 of debt in 39 months, and how we've been able to recycle and recapture every single dollar since then. This isn't theory. This is real. I mean, this is what the wealthy have been using over 200 years to keep the money within the family. This is literally where banks, conventional banks, store a boatload of their dollars at. And it's the same process that we've helped thousands of families across the country put into action. So go to themoneymultiplier.com/presentation and see for yourself how you can start taking control of your money today. All right, let's get back into the episode. All I heard was pay yourself first, is when you're saying that. And a lot of people don't do that. It's so easy, and we've all heard about it, especially if you are following a whole bunch of the big gurus that are out there, like the Robert Kiyosaki's and pay yourself first. So I do this. I literally have, and I can open up my bank app if I really wanted to, but I have a bank account that is titled pay myself first. So every time I look at it, it reminds me that I need to move money from my main account into that separate pay myself first account. And then that's what I will take. I will either pay my premiums with that money. I will pay back policy loans because I don't just have money sitting stagnant in the bank. I will go and take that money, go pay back some policy loans. There's no better place, in my opinion, to protect and store the money than back inside of my policies until I can go do that next investment. And yes, it is so important, y'all. Underwrite your deals. All of my real estate people, you should be underwriting. Don't just take that fund manager's word for it. There are a lot of people right now who I know ain't getting paid because y'all did not underwrite those deals yourselves. So I even learned that the hard way. I talked about it on the live stream not too long ago where, the borrower, right? So even the deal was super great. Well, hey, now I got to go and foreclose on him because, hey, Hannah protected herself, had the collateral. So even that, there was one time I was walking around, I was down in Mexico at my mentor's house, and she calls me up and she goes, hey, my premium's coming due, but I don't think I can pay it because I put all my money into this 24% investment. And the guy ain't paying me now. What are my options? What can I do? And my first question back to her was, well, what collateral do you have? Oh, I didn't take any collateral. Y'all, what do you mean? I watched too much of Judge Marilyn. Grab a piece of paper or a toilet paper and a crayon. Let's get this deal done, right? You want to make sure that you have, and not just promissory notes, right, Wes? You've seen that too. It's not just the promissory notes.
Yeah. If you ain't first, you're last. Yeah. Right. I learned that from your dad. You've got to be in that first position. You've got to tie up collateral. One of the best collateral stories I heard is Mike Fry when he lends on cars and boats and motorcycles. I love that approach that he takes with it. He gets the extra pair of keys. He gets 2 years worth of payments, post dated and checks, and he gets put on as the lost payee on the insurance. Covers all the bases. So that due diligence piece is essential, right? Because these fund managers have an incentive to sell. Yeah. And, I don't knock them for it because everybody's, we're all selling something. Everybody's got to make a living. But as an investor, you need to not just rely on what the fund manager is saying in their facts, and also don't rely on what your friends tell you either, right?
Or
Because
your siblings, Sean Kessler, Jack Kessler. Sorry. We were all on FaceTime last night.
I'm not mentioning any names here. So, but it happens a lot, right? People they get into that groupthink mentality where it's like, well, hey, Johnny and Sally and Bob are all doing this, so I trust them, and I'm going to assume they already did due diligence, and I'm just going to ride on those coattails.
Yeah.
You can't do that, right? Like, that's how people get burned. I've lost money doing the same thing, right? And you just you learn that, hopefully you learn that lesson one time only.
That's true. Yeah. And hopefully you're young enough that you can recoup after time too. That's a big one too. You're making me think now. I know this one individual who put a lot of money into a deal, and she's 67 years old and lost all that money. And it's like, and she ain't working as much. She's only working part-time now. But now she's going to have to continue to work just for survival because of her following some bad advice,
Mm-hmm.
and nobody's going to care more about your money than what you do.
Right.
And even too, like with the fees, we don't even really a whole lot like within the investment community. When you are giving your dollars away, even putting it into with assets under management, giving it to those financial advisors, yeah, they're charging fees. Okay, like I get it. You're managing my portfolio, but you always even have to look at investments after the cost, after the fees, after taxes, even. Where are you left with? What is that actual rate of return? What are you walking away with after that investment is done? And a lot of us just don't. It's really not that complicated, Wes. If you really think about it, all this stuff is pretty simple. It's just using logical thinking. Oh, that's funny. That's another chapter within Nelson's book, Becoming Your Own Banker. Logical thinking and reasoning, right?
Yep. Yeah. I mean, there's that gap, right? That gap between the sexy, exciting, and flashy rate of return and that boring, predictable rate of return, that gap is all risk.
Mm-hmm.
And the thing about it is, even at 20, 30% rate of return, it takes a long time to recover a 100% loss of principal.
It does. Yeah.
If an investment goes bad and you lose that money, to make that up takes either takes a long time, or it takes more high risk investing.
Yeah.
Right. And it's not worth it. Protect the money first, protect the downside, and be satisfied with the moderate. Don't chase the hottest, newest, exciting thing, because that'll always be there will always be that next thing to go after, and then it's just shiny object syndrome, jumping from one thing to the next.
And this may be a hot take though too, but you should just pick a horse and ride the horse. I understand it's important to diversify your portfolio, okay? But it's not going to happen overnight, in my opinion. I think that you should just pick the horse, pick what lane that you like. It's so cheesy, corny, invest in the things that you like, know, and understand. We've all probably heard that before, but it's so true. Understand this specific lane, and then when you're ready, branch out and do something else. Now, once you've mastered that, okay. But like myself, I got into lending. That was the first thing, because that's what Dad taught us as kids, being 18. Hey, you give me your policy cash value, and I'll pay you a 10% interest on it. Teaching us how to go and move our money, right? And so that was the lane that I was in. Now I'm into the lane of actually buying and holding long-term rentals, or just a natural flow. And maybe someday we'll get into commercial real estate, or multifamily, wherever I kind of want to go from there. But it's all within the one realm. Honestly, I'm not a markets girl. I know a lot of my clients, they've been doing really great on some of those stock options trading and doing covered calls and stuff. And it looks pretty cool because I'll see them be posting on Facebook, hey, in the last quarter, no, not the last quarter, it's like 6 months, I think you said. In the last 6 months, I made 50% profits from doing this options trade. And I'm like, oh, shoot, that sounds pretty cool. Maybe I should learn about that. But I'm not just going to go and put all my money into it right away without understanding it fully, right? It might take me a full year to understand.
Yeah. Well, and that's the thing too, is when this is going back into the conversation that I had with the client last night. So he's in his debt payoff stage. Okay. And he's asking about investing. I explained to him, I go, look, based on the balances of the debt and the cash flows of the debt and the rates of the debt, your biggest low hanging fruit is paying off debt. That is your investing right now.
Yeah.
Okay. I go, and we're probably looking at about a 2-year timeline. Now he's been doing great with following that process up to this point. And, people need that reminder. Hey, stay the course until it's done.
Yeah.
Right. So that's his investing right now. I go, but in the meantime, you've got a good handle on this process. So it doesn't require a lot of thinking and management to keep doing what you're doing. So now over the next year and a half, 2 years, start getting exposed to different asset classes and investment types with an open mind, and be attached to none of it. The only objective is to just get exposure to a lot of different ideas and kind of find what you gravitate towards.
Straight up. Yeah.
And once you find that thing that you gravitate towards, go deep on it, right? Become an expert on that topic until that topic no longer requires a lot of attention and management. And then you can start putting your attention towards some other asset classes and diversify that way, right? In the early stages, you need to know what the heck you're doing.
Yeah.
With what you're doing. Otherwise, you're just, you're going to get slaughtered out there. You gotta know your stuff with it.
You do. No, now, Wes, talk to me about when I'll kind of ask it this way. When you're doing your quarterly calls with people, after you've joined the team, what has kind of surprised you the most from like the reality, or from the client journey to now being a part of the TMM team? What has surprised you the most, I would say, from like client conversations, or just even in your own family? Has your own family been coming to you and asking you about, hey, because I see that you're doing some stuff with money over here, I want to ask you your opinion on some stuff? Well, what's kind of surprised you through this whole journey?
So if I let's go all the way back to when I became a client of the Money Multiplier, right? What surprised me was, at that time, I had spent so much time researching all these different things, and I had reached out to probably half a dozen different talking heads, as I call them, on YouTube. Okay. I may as well have had money waving it around saying, hey, write me a policy. Right? I have money and I'm healthy.
Yeah.
Right? The Money Multiplier was the first to respond.
Oh, that's sweet.
Some of those never responded to me at all. Right? So that actually surprised me, not about the Money Multiplier as a company, but that there's so many names and faces out there that are promoting IBC, but they don't even actually have the infrastructure to follow up with the clients in a timely fashion. Okay. Money Multiplier was right on the ball with it. Okay. So that was a big thing for me. The other thing was, prior to even being with the Money Multiplier, I had whole life prior to that. It wasn't designed specifically for IBC, but I wasn't new to whole life. Well, that agent I never talked to ever again. So any type of servicing, I had to figure that all out on my own.
Wow.
So that was a big thing for me was, from the time I got my policy, Larry was getting on to an implementation call with me. And then there was that follow-up call, a few months later, and that kept going, and I didn't have to pay for that. Right. So that stood out to me big time because I hadn't seen that before. Being on the team, I was surprised at how many people underutilize that service. That's available to me.
Yeah.
And it's not to say that there's a ton of people that do utilize it, but there's a bunch of people that don't, that could really be, if you're going to put all the time, money, and effort into getting the policy, you would think that they would be committed to, nurturing it and maintaining it over the long run. But,
almost like your companion. My YouTube viewers, wait, finger this way. Oh, I wrote a children's book, just FYI, called The Companion. And some adults even need to probably hear that message in that book. No, I know, because you got to nurture it. And two, actually, Wes, you did say this because you, my friend, you love fitness, CrossFit, right? Are you into CrossFit?
mm-hmm.
Yeah. Because I'm kind of at that boring journey right now, just within my even fitness journey, where I'm at that boring stage where it's like, okay, I've been seeing some progress, but it's not going as fast as I would want it to. So like, I'm at that like little middle boring stage, right? And most people will quit in their fitness journey because they can't get over that boring phase. And sometimes even with the policy, I think because there is like a lot of hype around it, because we are looking at, the longevity. Like when I'm even doing some of my teachings, I'm showing an illustration over the next 30 years. And so sometimes y'all will get into year 2, year 3, and it's the boring stage. It's the capitalization phase. We're paying off debt to free up cash flow stage. And a lot of y'all will just kind of stop because it's boring, right? It's a boring, guaranteed whole life, right? And so that's why then they go out and they over leverage the policy, then go out and try to chase all of those yields and 30% interest returns,
Yeah, it's that dead zone, right? Where the excitement of getting started has now worn off.
Oh, the honeymoon phase is done.
The honeymoon phase is done. And the excitement of the efficiency phase hasn't arrived yet.
Yeah.
Right? They get away from the campfire. They hit the lull, the dead zone, right? And that's that place where, an individual just they need to stay tied in. They need to stay around the campfire, keep learning, stay focused long-term. That's critical. You had asked about my, family, friends, people reaching out to me. There are some people that do that. People that I'm close with that I'll have conversations with about this stuff, or they just know what I do. So maybe they've been around me having conversations, and those are the individuals that talk. I am notorious. So this is like an accountability moment to the entire world. I'm notorious for just not sharing information, right? Like
I
do stuff, I just don't talk about stuff. I don't like to feel like I'm pushing anything on anybody, even if I know it's really good for them. It's like, if they want to learn about it, they'll come to me. They'll come ask me. But I need to be a little more outspoken with the message. So,
You have a 17-pound brain. Use it.
well, this is helpful. Being here, talking about it here, it kind of gets me out of my shell a little bit.
No, you are. You are a little bit of an introvert, which would you classify yourself as an introvert?
100%.
Yeah.
I'm an extroverted introvert. I get
that.
my energy from being alone, but once I get talking with people, I can hang out.
Yeah. What does Mr. Wesley do in his free time? What are you up to?
Right now, I'm doing a renovation on I guess you could kind of consider it a barn dominium because it's a garage. Yeah, so it's a barn style structure with a garage downstairs. It's a 2-bay 4-car garage with a 2-bedroom apartment above it, and it's old. So I'm doing renovations on that. So that takes up a lot of my free time. But like you had mentioned, I coach. I do fitness. I coach fitness. Spend time with family, girlfriend. Just stuff. I like to just chill and hang out on my free time. I don't like to be too busy, and I don't like to be going all the time.
I feel that. Wait, now what's the plans for this barn dominium? Do you want to live in it? Or are you gonna rent it out? Gonna sell it?
Yeah, I'm gonna live in it. It's out in the country. It's family property.
That's fine.
Yeah, it's got a 15-acre view of field and woods, and it's peaceful. I love it.
I feel that. Are you the type of person, do you want to grow your own fruits, vegetables, have livestock, anything like that, or nah, not really?
It's such an intriguing thought. I don't know. I like the idea of it. In practice, I don't know if I have the time.
It's a lot of work.
I don't know if I have the time to dedicate to the work required, but who knows, Who knows? Maybe in the future.
Well, good. Now, Wes, is there anything that I didn't ask you that you want to leave with the listeners?
I don't want to keep repeating myself, but stay around. It's warmest around the campfire, right? And if you've already been around the campfire, maybe you drifted away a little bit, get back plugged in to learning the things that got you to the point of getting the policy to begin with, and start getting yourself back on track, because this process has the ability to make a humongous impact on not just your personal finances, but multi-generational finances. Yeah. So, stay plugged in, keep learning, avoid the arrival syndrome, and, don't chase yields. Build a nice big base of capital that you can invest conservatively, and, don't chase the shiny object.
And you'll just be all right. Hey, y'all. If you want to get in contact with Wesley, I'm putting his email here up on the screen. So Wesley at themoneymultiplier.com. You can find him on there. Wesley, my friend, thank you for joining me today. And I'm happy that the community gets to know you more, because a lot of them talk to you, being their designated implementation agent. So call Wesley. I mean, he can help you. Okay. Now, without further ado, I had a fun conversation. I want to say thank you, Wes, for coming on. And I'm going to be back next week. All right. Next Tuesday, new podcast episode will launch every week. All right. So you can find it on the YouTube channel or on podcasting platforms, wherever you stream your podcast. Leave a comment, like the video, help your girl out, subscribe. Okay. And let me know what y'all want me to talk about and get deeper into. All right. We're all evolving, learning here together. You can find me at Hannah at themoneymultiplier.com. So that's my email. Hannah spelled the same way. Forwards is backwards. Hannah at themoneymultiplier.com. But until next week, let me know if you have questions. I'm always here to help and serve you. And I'll catch you on Thursday, 9 a.m. Eastern time, Money Mornings with Hannah. Until next time, y'all. Bye. Hey y'all, if you've made it this far, this is where most people stop, and that's why they continue to be stuck with their money. Continue on with your education. Click right here. It'll take you to the next video.